Morning, guys. How's everybody doing? Thank you for being here. 8:57. I was trying to come on a little early because I was explaining a complicated option concept trying to a friend, and I was just going to talk about it on here also so they could watch it. But let's do the normal report. But at the end of this report, we're going to have a little lightning spread, theory, the theory of lightning spreads, kind of a follow-up on my video from the other day. But anyway, you guys can tune out if you don't want to see that. I'll do that at the end. Then I can just send my friend the link. But anyway, okay. So let's start with TradingView. See what's going on. CPI went well this morning. I was up watching Trade Brigade, and we made a new local high right here. And then we've come. It looks like we're pulling back, and we're back inside the local high. So we did close one time period. Anyway, it looks kind of like a look above and fell at this point, but I mean it's awfully early. Could be just checking this POC and then boom, off to the races. Let's see what MNQ is doing. POC, I mean point of control. Same thing here. They're maybe just checking the POC, or maybe the move this morning was BS and it's rejected and it's just going to get back here and grind. It's always a possibility. We can either go up, down, or grind, right? There's three possibilities. So, but sometimes, I'm just trying to, the positive case is this was too high this early in the morning. We'll come back and check the POC, and then buyers are here. Boom. Or we could even come back and check this low volume node and look exactly where we checked last time on the NQ futures, the low volume node. And that would have been a good, day trade. These 30-minute bars are pretty short-term charts. Most people probably use daily charts and stuff. This is more for short-term swing trading and day trading, intraday trading. Anyway, all right. Well, let's see now. Bitcoin's flat. Yeah. Bitcoin did the same thing a few days ago. Maybe Bitcoin knows. Bitcoin knows all. Bitcoin's like the new VIX. The 10-year knows all, and the 10-year is a little bit on the discouraging side. And we had a bull cross down here at 423, and we rallied, but it's nothing. All right. AMD is down. Amazon down a little bit. ARK is up. Coinbase, gosh, come on, Coinbase. I was hoping they could put 2 days together in a row that are good. I saw that they just got added to ULTY last night. We're going to talk about the crypto trinity here in a second. But we want Coinbase to do better for the sake of ULTY, even if you don't have any Coney. I think I have a little bit of both. I have a lot of Alti and a few shares of Coney. All right, well, let's see. Crash is up, so that must mean Tesla's down. GME is grinding, building out this lower point of control at 2275, call it, something like that. Google, look at that. Would you take a look at that? Let's look at a longer chart of this. Let's look at a weekly chart of this. Yeah, I love my friends who told me back in the last day of the year. I love talking about this. People don't know anything about the market. They're too into social media, and they told me that Pelosi dumped $1 million at Google right here on the second to last day of the year. They told me he must have known something. Well, how much did he know? Come on, tell me what he knew. I mean, not only that, another fun fact for you guys. Everyone talks about Pelosi does better than a hedge fund. Well, yeah, this year, in 2022, Pelosi was the number one worst member of Congress. They bled off. They burned more money up than any of the other traders. That's not what a hedge fund would do. They're freaking Paul Pelosi's a YOLO bro. He has a lot of money and he likes leverage. I mean, go look at his 22 record. He lost more than any other member of Congress by a long way. If he'd been working for a hedge fund, he would have got fired. Anyway, that kind of stuff makes good social media clips, but we have to live in the real world here in the financial industry. And I would just advise it against trying to follow politicians at all, because you don't know what their intentions were. In this case, he was selling because it was tax loss harvesting. I didn't have a channel at the time, but I told all my friends it was tax loss harvesting. And you can see why it was, because he had a really bad year and he needed a tax loss. It wasn't that he didn't like Google. He still has plenty of Google, or he probably bought it back after his 30 days was up. Just don't look at that. That congressional trading stuff is, of course he's up big this year. He's using leverage. I mean, he's using leverage and the market's up big. It's not, they may be crooked also, for sure, 100%, but the trading doesn't prove it. You have to dig a lot deeper than that. And I don't support Pelosi. I don't support Democrats. I've never voted for Democrats, but I live in reality. All right, Marcus, what's up? Sorry to rant this early in the morning. Hey, all right. Let's do some other stuff here. Let's look at, okay, we're going to look at the lightning spread later. And you guys might like the lightning spread also. But let's look at the crypto trinity. Why don't we get this show going the right direction? Did anyone see my video? God, I was up late last night. That's why I'm so grumpy. It's probably up till 3:00 in the morning. I shot my video about the new Defiance Fund, HOT. Anyway, it's just a 9-minute video, and they just came out the prospectus yesterday. I just wanted to get a quick video out, but anyway, then I decided to reshoot it and do some different stuff on the video. Anyway, let me know if you guys liked it. All right, so let's get over here to business. So Alti added, let's go to the Altiverse. They added Coinbase yesterday. Let's see how that's doing for them. Well, Alti in general is up 33 bips. Average is up 1.37. That's good. Where is Coinbase on here? Coinbase. There it is. And it's only down 1%. It's not hurting as bad as some of these other ones are. Do they have UVIX again? I didn't know that. You got to be kidding me. Okay, so I have something also called the, I'm supposed to know this stuff. I just don't have enough time to, I was busy making content. We have a big interview coming up tomorrow at 1:00 with Greg from Twin Oak Capital or Twin Oak ETFs. Nice guy, smart guy. I don't see UVIX on here. That's holdings. Okay, stock positions. Yeah, there it is. Okay, I just missed it. It's a small allocation. So let's see, Alti stock positions. What's Alti beta change? God, I was up too late last night. Did I even do that? Oh, gosh darn it. You got to be kidding me. All right, hang on here. I think I have multiple Alti trackers. Anyway, it's cool to have UVIX again. I love it. I'm not against it. I just want to Trade Tracker Alti, I think is the newest one is called. The Alti tracker's dead. The Trade Tracker Alti is the newest one. And it's the one, yeah, okay. So here's their trades yesterday. And I don't show any UVIX, but they also bought coin and it didn't show up in the trade tracker. I don't understand how that can happen. Trade tracker history. So I saved the trades from yesterday, and Coinbase or UVIX was not on yesterday's trades. Alti positions. Let's just look at the full thing. Okay, 811. So, okay, so they don't have UVIX because that other tracker was from a long time. Okay, forget about UVIX. Sorry about that. But but they do have Coinbase, and here's another. They do have Coinbase, and it shows up right here in their positions, but somehow it didn't show up. It didn't show up. It's supposed to show up somewhere else. It should show up right here because these are all the trades they made yesterday. Anyway, well, they definitely have Coinbase. And I can look at the day before. They definitely didn't have it the day before. So I just need to start going to ETF Delta's page. I just can't believe I can't generate something decent myself to look at. But his stuff has it. He has it all straightened out. So anyway, go check out ETF Delta because I have no idea what I'm talking about. Obviously, I mean, here it is right here. Trade Tracker Alti, 67,000 shares, $250 million worth of stock, and my darn Trade Tracker didn't pick it up. I mean, there it is. Anyway, all right, well, and this is the previous day, so I'm trying to find a way to see the changes. I guess they did have it the day before. There's 811, but 811 was yesterday. This thing's all jacked up. I have no idea. 812. These are just the option trades. Anyway, let's talk about something I do know something about. So the option trades, they have on a two tranches of call spreads. They sold the 320s and the 332.50s. Oh, I'm sorry. Two tranches of callers. They sold the 320s and the 332.50s, and they bought for protection. Well, and they bought a put spread for protection. They bought the 280 and then sold the 255. Okay, that's a baller move. That saves them a little bit of money on the puts. Okay, that's cool. That's kind of a new strategy. Or actually, I heard ETF Delta talking about it the other day, so it's new to me. But like I say, I just need to start watching his show. He does have really good content. I just can't believe I can't make my content. This sheet AI should be able to tell me everything, but it just. Anyway, all right. Well, all right. So that's Alti. So let's go back to the crypto thing. But gosh damn it, how is UVIX in it over here? I don't get it. Is that Alti? That's the Altiverse. Jackson thinks I'm mad at him. Jackson, it's all right. I'm not mad at you. Jackson's saying, what did I do? Why are you cussing? Why are you saying, gosh darn it? How in the heck did UVIX get in there and I didn't see it? Alti positions, position history. That's the 11th. The other one was the 12th. UVIX wasn't there. Alti stock positions. UVIX isn't there. The other sheet's got to be jacked up. The Crypto Trinity's got to have a bad reference in it or something. But that's another problem. But anyway, I'm not even going to worry about that. I mean, all right, let's look at LFGY. Maybe this one works. Probably not. All right, LFGY is just doing well, up 1.29%. That circle, of course, isn't the live quote. That makes me mad too. But that really doesn't make me as mad as the other problems are a Max problem or a Mike problem. But this one is not. This is a Google problem. Anyway, Circle, last I checked, it was up like 10%. So let's go look at Circle. Okay, it's up 4%. So 6%, 4%, whatever. I'm not going to change it on the chart. Maybe it'll be up 6% by the end of the day. Whatever. Just subtract a little. Okay, that's the Alti tracker. That thing is dead to me. All right. All right. It says 6, but whatever. So it's just making the average a little higher. Subtract 2 points from that and take a little bit off this. We aren't really up 96 basis points. We're probably up 85 basis points or something. Anyway, but that's good because LFGY itself is up 1.29%. Great job. But yeah, that freaking stock, that HOT is going to be absolutely insane Did you guys watch the video if you haven't watched it? That thing's going to be insane. All right, let's see if blocks is screwed up. Well, it doesn't. Well, it has circle in it, so the circle thing is messed up a little bit, but whatever. It has the average stock up half a basis point. We'll take it. It's really a little bit less if circle reflected the right price, but the important thing is the market's never wrong, and the market's valuing blocks up 1.2%. So the market matters more than this. Anyway, I just thought it's good for comparison purposes to see. It's like a buffer report. See how much the stocks are up, see how much the market's up. All right. So I was all excited when I thought that Alti had UVIX again, because volatility's gone down as we make new highs, and it makes sense right in front of that number. I wonder if the number would have been bad this morning. So yeah, here's a historical look at Alti. Option positions from 8-1. Why is it showing from 8-1? But anyway, but that's when they did have UVIX. All right. That's in the Crypto Trinity. I guess that's just an old spreadsheet. All right. Well, sorry, that was kind of a bust. Stick around for the lightning spread stuff at the end. I have some good content planned at the end. It's for one person, but the rest of you guys might be interested too. All right, what else do you guys want to talk about, or what else is going on? Yeah, Mark over there in Discord said he thought that they weren't going to approve any more 3X funds. That's what Jay has said before, and that's what I understood too. But they DGAF, I guess. All right. Hey, Mike, how are you doing? So how many mics do we got? 3 mics in the house today. At least 3. Well, God, there's only 2 people watching this. So anyway, this is one of my worst live streams ever. It must have been I made everyone mad when I started talking about Pelosi and I started talking about politics. Anyway, it's whatever. All right. So let's see what else we have going on. Let's look at the index buffer report. That's always a hit, right? That is always a hit. And my friend is commenting in Discord. I don't want to open it on the live stream, but maybe he's watching or whatever. I told him I would talk about it this morning. So maybe he's watching, or if not, I'll send him a link. All right, but I was trying to clear up some stuff. All right, so on to the buffer report. It's not feeding FIBE this morning. Are you serious? It's Y-SPY and SDTY. Wow. Great job. SFAL, good job. SEPI, good job. We got lots of outperformance here. RYLD, IWMY, lots of good performance. FEET, FEPI. Anyway, all right. Well, yeah, actually, FEET's down a little bit, but anyway, at least it's not down. At least it's not down the most or up the most. And SFAL also didn't do that. All right. So what else do we have to talk about? I guess nothing. I guess I'll just tell you, it's the Mike Club here. I guess I'll just talk about, talk about this thing I want to talk about. Well, let's go to the high yield technical analysis, because you guys probably want to hear that. And then you guys can tune out if you aren't interested in the lightning spread and that video I made the other day where I simulated an ETF and I pretended like and it had to do with those. Wasn't really so much about the lightning spread. It was about using a 33 delta leap for your long substitute. And that's what I'm going to talk about this morning, and the ins and outs of how that works. So I promise not to get mad if XYLD's on there again, but I'll probably get mad if XYLD's on there again. Maybe we'll just look at the short-term top 20 list, because I know it's not on there. We'll do the long-term top 20 after the market closes. How about that? Maybe I'll be in a better mood by then. All right, short-term top 20. It's going to be the usual suspects. It's going to be NVDW. And where's NVDY? Why did NVDY drop off there? Probably a data problem. Anyway, number 1 is NVDW. Number 2 is AMD. Number 3 is PLTW, then PALTI, COIW, OARC, QDTY, Goop, YETH. Boy, that ether's hot lately. GPTY, I like that one. CLM, we were talking about that one in Discord. Somebody was saying they didn't like it, and I don't particularly either, but just because it's not as transparent and they don't do options and whatever. It's a closed-end fund, but I mean, I don't dislike it either. But I did make the point that it's consistently in the top 20, comparing against all these covered call funds when you look at risk versus reward, and you factor in yield. I mean, I guess yield's your reward in a high yield fund, but you also have your reward in NAV return. But this thing is, like it or not, this thing does pretty well. And it, and forget about the max factor. It's like a Morningstar 4-star fund or something. So, maybe someday people will quote the max factor like they'll quote Morningstar now, but I doubt it. Anyway, and you could see the rest right there. I love to see triple QI on there. Has a low return for the quarter, only nearly 4% compared to the other guys, but it has a lot more yield. And it didn't do bad last year either. I mean, it made 12% last year. It did all right. So I just don't understand where NVDY went. Let's get let's get the bigger list going. Let's create the dashboard list. I mean, there's no way NVDY is not in the top 20. Maybe they just paid a dividend and because of that, I mean, and the dividend knocked their NAV down enough to knock them out of the top 20. And it hasn't factored into the yield yet or something. I mean, I guess that's possible. So let's just look at the full list and see where we're at. Where is NVDY? Come on, NVDY. There's no way NVDY. Gosh darn it. You got to be kidding me. Let's just go to the database. Is NVDY one of these that's saying well, I know this isn't very engaging comment, but sure, a freaking enough, it's saying NA, and it shouldn't be saying A. I mean, it's just, oh my gosh. Anyway, it's whatever. All right, well, that was a bust. I can see why there's a lot of NAs after hours, but when the market's going, I mean, I just don't get it. I mean, it's just, anyway. All right, well, maybe I should stop doing the max factor. I don't know. If I can't get better data, I mean, it's useless when you can't, I mean, anyway. All right, well, hey, Mark, how are you doing there, bud? All right, so let's talk lightning spread. Or let's talk about the video I made last week. So my friend was saying, well, first of all, here's what the lightning spread, here's what that strategy that I was back testing looks like. That's this goes out till, oh shoot, I'm sorry, my bad. I'm sorry, I slipped up. Okay. This is the 7100 call. It's a 35 delta. It's as close as I get to 33. I could either use that or I could use a 30 delta if I go out even further. And these have a $3 bid ask spread, but on something that expensive, it's not a huge deal. That's your long right there. That goes out a year. We're just going to keep it a month though, because remember, you can either, if you just want to do this part of it, you could just keep it and roll it every 30 days. And that tested out really well. But I was trying to simulate a fund generating a yield and trying to devise a plan where you could pay the yield without messing up the NAV. So what I came up with is a what I call a skinny lightning spread. This is selling a 60, which is an in the money call, which is a great strike to sell. That's what Defiant sells, and it's an in the money put, but that is the same thing as an out of the money call. That's like selling a 40 delta call. You get some upside in this put trade, believe it or not. You get 10 deltas worth of upside. Anyway, or actually 5 deltas, because then you're turning around and buying the 55 delta. But so this is just a super skinny, and I made it that way because you just make a yield, but without adding any more risk than you have to. to the position. So this right here, you could sell this one for $99. You buy this one for $91. The difference is $845. You have to exclude this one to show it, but the spread alone is $845. My friend was asking, well, he said, well, the spread, how does that thing have losses or drawdowns? Because the spread, the Lightning spread is, or it's a put spread. You can't lose that much on a put spread because you have the put spread. Correct. You can't lose that much on the put spread. You can lose $1,155 though, which is the width of the strikes, which is $2,000 or 20 points. So, right. Yeah, $2,000 or 20 points. That's the width of the strikes, even as skinny as it is. Less your $845 and the loss is $1,155. Okay, well, that doesn't sound too bad either. But remember, you're running the whole thing together. So that's where the drawdowns come from. So the example I was showing him is if the market's down 5%. In this next month, and these are a month out. This earns $845 a month. Multiply that by 12, it's like $10,000, and it's only on $20,000 worth of risk. You could run this position for about $20,000. But you can make a pretty good yield if you use $20,000 and you make 10,000. That's 50%. In my example, I was just trying to take 24% out of the market because I was trying to leave some in. I'm purposely trying to be able to have a trade where the strategy can support the yield, but the yield is still something that's attractive. But there's no way, but here's where the drawdown happens. The drawdown happens if we go 30 days. Okay. And the stock's down 5%. And that's a pretty good month. That happens, happens all the time. All right. You'd be down about $11,632. Well, I could exclude the spreads and you're down like $10,500. And the difference is the $1,100. So the spread adds $1,100 worth of risk, but you have to factor in, especially if this is an ETF. ETFs are marked to market continuously because they trade all day long. People see the market drop 10%. The price will go down to reflect reality. So that's where the drawdowns come from. Now it's not all bad news though, but you have to factor that in. The other thing is after 30 days, you're just going to put the whole thing on again. So you're gonna take this one from. So let's just see what happens to the. Let's just do it like this. Oh yeah, that's okay. Now we have to go out 30 days. Here is just the synthetic, just the long substitute. So we go out 30 days right there. There's 30 days. Okay. And we're down 5%. It's like 10.5. It's the same example I showed you plus $1,100. Okay. Well, the good news is though, if we go up 5%, we're up about $11,000. Plus, don't forget, I excluded the puts. But we're up 11,000 plus 845. Okay. So it's like anything else. This still needs the market to go up. If the market goes down 5%, 40% of the time and up 5%, the other 60% of the time, this thing will make bank. And not only that, it'll make more money than, let's look at this one other way. Okay, so let's compare it. Let's compare this to doing the Lightning spread with stock. Because the main thing I'm touting here is that 33 delta call for the long. It may seem like $10,000, that's a huge loss or whatever, and it is, especially on only $20,000 worth of risk. But if we were using stock, and we can't use stock because this is the SPX. So what do most funds do? And I said this in my presentation the other day. They use the 90 delta, the deep in the money. But that does replicate stock pretty darn close. If SPX had stock, or we could do a synthetic and at the money synthetic, it'd be the same thing. Plus, we could just figure out the math. SPX is a $640,000 instrument. If a $640,000 instrument drops 5%, you're down, 31,000 or something, right? Well, let's look at our synthetic. If our synthetic drops 5%, or deep in the money drops 5%, this has you down 60,000. How did that happen? It's because of, maybe it's because of this. I think I have the other one still turned on too. No. Well, anyway, suffice it to say, oh, I know what it was. I know exactly what it was. Okay, you aren't way down 60,000 because when you use a deep in the money, you start $28,000 in the hole or whatever because of the cost of this thing. You know, this thing cost $1,116 a contract times 100. So you know you start in the hole. So really, you aren't down. You wouldn't really lose that much. You'd be down the difference between 27 and 60, which is about 32,000, just like I said. So you could use stock, and you can use stock in a lightning spread, and that's what blocks does, and that's fine. But if you do that, you're down even more. You're down about 3 times as much as you are on the synthetic plan. So, but that's what I was trying to. This right here is really good. Look, you have limited loss. Wonder if you're down 10% in a month. Okay. Now you lost 17,000. Wonder if you're up the same amount. You make 40,000. It's asymmetric. That's what options can do for you. This is a cool plan, but it doesn't sidestep losses, and the losses are marked to the market. So that's where the drawdowns come from. In that sheet, my ETF simulator, one of the reasons it did so well is because ETF, what was that thing called? One of the reasons it did so well was because it started in a good year. If you started in a bad year, it probably wouldn't do all that well. That's a sequencing returns risk. But I was just trying to make the least risky way I could think of to make a yield on top of some type of long. So what's that called? That thing is called the ETF Lab. But on this, had it not started it right at that perfect time, see, a hedge fund or somebody like Jay, they use something called conditional value at risk, CVAR, and they also use Monte Carlo simulations. And they would probably start with more capital than I use. That's also probably why mine tested so well, is because they probably would have started with more capital and to sustain a bad run. It doesn't mean the strategy wouldn't work, but it's just. But anyway, let me show you this. Okay, so right here on this simulation, no, not that one, not that one. Yes. Okay. On this simulation started in 2013. Well, look at the NAV. I simulated the NAV, and the NAV went all the way up to $41. But then it went all the way down to it hit a low of $24. So during that time, they were having to settle more losing trades than they were getting winning trades, because there's no such thing as free money. The market went down, but they did get off to a good start. But I can change the amount I started with. I could make the amount I started with $40,000, and that's why I made it where you can change it. And I could also change the amount of the dividend. Instead of being 2% a month, I could try 1% a month or something. But at 40,000, your returns, the good results I have would be halved. Now the risk would be halved also, but anyway, so if I started with 40,000, it just makes the NAV 40. But anyway, same thing. The NAV goes up to 60 basically, and then we're back down at, because you have losing trades and you have winning trades. You still need the market to cooperate, was the whole point of my thing. There's no way to sidestep losing trades. That one, using that out of the money leap, makes it where you're exposed to $10,000 of downside instead of $30,000 of downside like you would be if you used the stock. So it's not all bad news, and it's an asymmetric trade. I mean, but you're still, like anything else, it's still a bullish play. It's still a bullish play. You're still long the market. All right. So anyway, that's enough for that. trying to figure out where to put SPY. Okay, well, Greg is going to be on the show tomorrow. Maybe we can ask him questions about SPY. I think there's another one called TSPX, or SPXT anyway. But SPY is the one SPY A is the one I'm interested in. We'll talk to him about that. Hey, Dan, thank you for being here. Did we already discuss the low volatility option trades you were? Oh, I forgot about that. No, well, let's do that. Let's do that right now. In fact, we're doing the option part of the show, but we haven't done that option part of the show. Okay, well, let's look at the earnings trades. The earnings aren't going very well. I mean, maybe they are. I don't know. Okay, so this one right here, the top one is the lightning spread. That's the example I just showed you. So we'll just start paper trading lightning spreads, I guess. It's just a once a month deal. I mean, we just have to do something once a month, let it expire. All right. Soundhound, that one's up a little bit. Oh yeah, because remember I was showing how to take a shot on it. Just anyway. Okay, that's not an earnings trade. So okay, on ON we did two things. I was trying to simulate the fly-agonal, and it's working. One side's up nearly $90, one side's down $25. So I mean, it's working right now, kind of, I guess. So, but the bullish trade on ON, which is just going to be a whatever I do, risk reversal, selling puts, buying calls. That's up $113. Bullish earnings on Circle is up $48. Oklo. I've heard it pronounced Oklo. So Trade Brigade guy Matt says Oklo, so I need to start saying Oklo. All the cool kids say Oklo. I'll quit saying Oklo. Anyway, Oklo's up $27. Anything else? Pens. What are those? Are those from last week? Yeah. Well, anyway, those are all the ones yesterday. Okay, what Dan and I were talking about yesterday, and I forget, maybe I was talking about this on a live stream or maybe just texting Dan. I don't remember the exact thing, but we're talking about buying insurance while it's cheap. So let's go over here and let's see if we can set up an insurance trade. Oh, Dan was saying September is the worst month in the market. I think it's actually August, but August and September. But I really think it's October. But in my mind, October is the one I'm most afraid of, just given my history or whatever. But mathematically, I think it's actually August and February. But September is a bad one also. And I could be wrong about that. I could be wrong about that. All right. So when we say insurance is cheap, I mean, $12 or whatever. Now that's the 30-day measure of volatility on the SPX. So I think of the VIX. People call it the fear gauge, but it's the market. It's the cost of doing business in the market. It's the interest rate. If the market had an interest rate, it's the prime rate of the market. I mean, because just like a bank raises their interest rates whenever there's more risk on the horizon or whatever, interest rates go up. The market sets their interest rate, which is the VIX, the volatility index, continuously. So let's look at a daily chart. Anyway, so all we were saying is since it's so since volatility is cheap right now, let's see if we can set up some kind of cheap protection trade for September. So what day is it? It's the 12th of August. So let's just go to mid-September. So let's just see. But the problem with these things, even when VIX is 12, these things are super expensive to set up, or they can be. But let's look. I thought it might be fun. So let's look at. Let's just do this. I'm just going to do my own thing. Boy, Rod has a good interview on today with a guy named Mike Coe, who's an Austin guy. He lived in Austin. I followed his career. He's been on CNBC. He's the ultimate option bro, just like Jay, or just like a lot of them. I mean, there's 5 or 10 option bros out there that are in social media, but he would be on the Mount Rushmore of option bros. He's working for YieldMax now, and he's going to be on Rod's show. I mean, I didn't know that, but Rod's thumbnail says he's interviewing Jay Pestrichelli and Mike Coe of YieldMax, or YieldMax's new employee, whatever, something. So I'm going to definitely be watching that. Mike Coe has a live stream 2 days a week, Mondays and Wednesdays. And I watch his live stream all the time and comment, but it's usually on at the same time ours is on. But so I don't get to see it sometimes as much as I want to. Anyway, but anyway, him and Rod are talking today at 3:30. I'm going to for sure have ours finished at 3:30 so we can go watch theirs, and then I have consulting at 6. But anyway, so be here at 2:30 today, and it's not going to go longer than an hour. Okay, so let's try to set up this trade. I was telling Dan, about this trade where you selling at the money call right there. We'd sell the 19 delta call. See, the thing is, you have to pick an expiration. Well, it's VIX futures. When you're trading the VIX, the underlying is the VIX futures contract. Now, these aren't futures options. They're actually like SPX options. But SPX options are also, their underlying is the ES futures, I believe. Anyway, so we went out here to September 17th because, I mean, it'd be really expensive to October. If nothing happens by then, maybe we could put it on again or something. Anyway, so here's the trade here. We're gonna use 2 calls. We're gonna sell a call, and then we're gonna buy a call, but we're gonna buy 2 calls. Okay, now we're gonna create a gigantic valley of death, the mother of all valley of deaths. But what it does is, if let's say the market keeps rallying from here, that it's essentially a free trade. In other words, if cash VIX, which is at 12 now, doesn't reach 19, which is where VIX futures are a month from now. That's because you can see it right there, or whatever, that's the underline. If it doesn't reach 19, by then you'll be this trade will go negative or whatever, but you can't lose no matter how high VIX goes. No matter how low VIX goes. VIX goes low when the market goes high. Well, you essentially have no cost there because one pays for the other. You're just trying to beat this valley of death. And that's usually what happens, is it'll rally right to the middle of the valley of death. Not the most perfect trade. We're going to look at 2 ways to hedge. I think I have a better way to do this, but this is the way pros always tell you to do it. It's a call ratio back spread. But the advantage of it is it ties up $700, but you don't get beat by the market rallying is the good thing. The market rallies, VIX stays under 19, you make $8.50. It's but you need the market to go down quite a bit and to go down enough to make VIX go up. And the break even at expiration is 32. So, this would protect a big move. VIX goes to 35 or 40. And that doesn't happen very often, but it could. I mean, and if it does, September and October, the months, August too, that it could happen. So anyway, so that's one way to do that. That's a call ratio back spread. Let's save that trade, and then I'll show you a better way to do it. These guys don't know what they're talking about that invented the call ratio back spread. They obviously have no idea. I'm just joking. But anyway, so that's protection for a month. That's one way to do it. You could also do it with an ETF like UVXY or UVIX. In fact, we're going to do the other trade with UVIX. But UVIX has issues too because it has erosion, it decays. So you could put on a trade right now in UVIX and the market could go up for 2 weeks and then drop, but your UVIX erodes a lot when the market's going up. So it'll go down and then the market will drop and UVIX will come right back to the place you started from. It's just the built-in cost of it. It's kind of like futures need to go, or cash needs to at least go to 19. It's just the built-in juice in the trade, I guess. So anyway, but that's one way to do it, but here's a better way to do it. So you get out, you go over here to UVIX, UVXY, whatever. We'll use UVIX and you sell you a put spread. And you have more dates here on UVIX, so I guess we could go out. We'll go to the same date just to make it a fair comparison, but I usually like to go to the 3rd Friday, we'll go to the 3rd Friday. Okay, so that VIX has weird kind of expiration dates. Don't use VIX. VIX is a strange instrument. Probably use UVIX. All right, but let's find a small fry way to hedge this thing. All right, so we aren't trying to take our wife to dinner, but we're going to do a risk reversal. but we'll take her to dinner if this hits. But because we aren't going to take the $54, we're going to spend that. We're going to spend that, or it's going to be $108, but we're going to spend that on a out of the money call. So it's the same theory as the other trade. You just don't have a valley of death. The hedge funds have been doing it wrong for all these years. They should have hired me. We'll essentially do the same trade. All right. So, yeah, and this is the same concept. It's free insurance. If nothing happens, you make $16. I mean, it's free insurance. But if the market rallies big, UVIX will drop, and you can expose yourself to $584 loss. That's what you're betting against. The thing is, if the market rallies big, you should have other positions that make more than $586. You should, the rest of your portfolio ought to make $1,000. Let's say, even if you have a small portfolio, you have a $20,000 portfolio, and the market rallies 5%. What did you make? Something like $1,000? Yeah, exactly. Okay, but then you lost 500 here. Okay, well, that sucks. You shouldn't have put on the trade. But you don't have a valley of death. And if the market goes south, you have this one. So anyway, I think either way is a way to do it, and I'll give you a third way to do it. But that's protection for September. I don't have to write a note. You guys know that one. I'll give you guys that trade in case anyone wants it. But then let me show you a third way to do it. Hey, Jonathan. I'll look at your question in just a second, but I have to stay on my train of thought, or I'm older. Well, you know about being older. Jonathan and I are both senior citizens. Doesn't that start at 55? Or you qualify for all kinds of benefits at 55. So I've been one. Heck, I'm going to be 59. I've been one for 4 years here in a month or two. Anyway, all right. And I've already lost my train of thought. True to freaking form. A third way to do this real quick. But that's the way to do it. Both ways tie up $500 or $600. You could do it either way, and you could also use UVIX and do a call ratio back spread. I just don't like the valley of death. Anyway. But they're both legitimate ways to do it. Back to editor, and then also here's another way to do it. You could just do something like this. Well, there's all kinds of ways to do it. You could do a poor man's covered call. You could do all kinds of stuff. So let's build I guess I'll just do it with the same thing. Okay. Let's just get rid of the puts, remove. I mean, if you have $500 you want to spend, you could also just buy this. I mean, you tie up the same amount of money. You're going to lose it most likely, but you have a bigger degree of protection. If it goes, I didn't see what the other one makes if it goes to 40 or 50, but that's one way to do it. But here's a better way to do it. So that ties up 500, but let's try to do it a little bit smarter way. Let's buy like an out of the money slightly, like a 20. That's a 39 delta, called a 40 delta. Or let's just see what an at the money would cost. Lots of money. And at the money, we don't want 6 of them though. We just want one of them. Ties up $200. And then what we do is we're just doing a spread and make it where it's, watch this. So this one right here is bringing in $53. This one's costing you $254. So you get this one for $50 off. Maybe something like this. This one brings in $93. So the whole thing is $160 debit. Remember, the other trades tie up $500. So you just do it like that. Do it 3 times. Well, heck, we'll do it that way. We're going to do a 3x2 because we'll leave ourselves a little bit of theoretically unlimited upside. Ties up about the same amount of money. We'll just do it till it is the same amount of money. There it is, 500. Okay, we could do that 3x2 call spread. Probably going to lose $500. The other ways have an advantage of you may not, depending on the path dependency. but anyway, so there's the third way to do it. I think the third way may be the best way to do it. I don't know. What do you guys think? All right, save trade. Let's see. That's another hedge. So I'm going to say this is a new trade, and I'll share this. Copy link, and I'll give that to you guys. Okay, Jonathan, I'm going to get on that question and any other question that there's out there. I apologize for talking so much about options. I hope my friend watched that one explanation on the lightning spread, or I hope you guys got something out of it. All right. Hey, friend. Yeah, Jonathan, I appreciate you being here. Like I always say, is there a chart that shows the IV of an equity like the VIX tracks? Yes, there is. And there is. Let me think about this. I was just talking to Scramble about this yesterday. I just don't like the Tasty Trade charting. I mean, but how do I make this chart bigger? I guess I hit chart over here. So let's say we want to track the IV of Apple. So we would go up here, AAPL, and I think we hit .IVR. No, that's not it. But there's a way to do it that's like that. There's, in fact, Scramble and I we're talking about it, and he said it's in. If there is a way to do that, I don't know how to do it on Tasty Trade. Check this out, Jonathan. Go to Market Chameleon. Okay, back to the Apple example. There's a way to do it on Tasty Trade. I thought it was you just typed IVR after it. But actually what Scramble told me is it's in the indicators. But I sort of got, it's not in my indicators. But then that's right. Scramble and I've been through this. I told him it's not. And he said, yeah, it's because you're using the web-based. It is in the other platform. But the other platform is signed into my other account, to my I have a different account, but I like to stay signed into my brother-in-law's because that's the one I talk about on the show. So anyway, but you can do it in a Market Chameleon. Right here, 30-day implied volatility. They have historical right here. So right there, you can see you have to subscribe to get this, the IV30 full chart. Oh, no, there you go. Register for free. I mean, I've already registered. It has me in here. I just haven't subscribed. Continue with Google. But anyway, that's going to be that's going to be the other way to do it. Is that what you want to know, Jonathan? I may have. I hope I didn't miss the mark on that. If that's not what you want to know, let me know. Yeah, I'm really looking forward to Retire on Dividends interview, but my interview with Greg from Twin Oak is going to be good tomorrow also. So IV30 full chart. Let's see if we got it. Yeah, there it is. All right, Jonathan. So there it is. And if you subscribe to it, you can even, and there's the stock price for, okay. So you can see, the thing about it is when you're looking at the SPX and SPX vol always goes up when the SPX goes down, or always. Stocks can run the same direction. The volatility can go up at the same time. Price can go up. And that's what makes funds like Misty so attractive. And that's probably why Jonathan's asking. And Coney, there's situations where the IV goes up at the same time. So Jay is increasing the dividend payments. He's able to because the IV's up. So his option selling strategies are more effective. At the same time, the NAV is going up. Whereas in an index fund like I like or whatever, triple QI or QDTI, Q whatever, it doesn't even matter. It's the opposite. When the market craters, you're going to get bigger dividend payments, but it's going to put a hurt to the NAV. But that's not always true on individual stocks. And that is the best case I can make. I'm not a big individual stock guy, but that is the bullish case for the individual stocks, is the fact they can go the same direction. In fact, let's just look at that. Let me show you an example of that. Mister's a big example of that. Tesla's an example. Tesla went up after the election at the same time its price went up, at the same time its vol went up. Here we go. This is the OG example. Right here is the price of Mister. The price of Mister, September 10th of last year, right? Right before the election, Mister's price was at 130. And then Trump won. Happy days were here again. Mr. went all the way to $473. Well, remember, even though he won, there was a big, what's he going to do for cryptocurrency? Is he going to be bullish for it? It was driving cryptocurrency speculation up. At the same time, cryptocurrency IV was going up. So look at this. The IV went from a 91 IV, which should be like a VIX of 91. But that's, that's about where right now IV is 51, but, so call the average 60 or 70. But and it's trading at 60 or 70 back here. There's 74, whatever. Before the election, it went up, at 101. But then after, it went up to 226. So that's the reason people fell in love with MicroStrategies and people that don't understand options or whatever. I mean, but that's like a unicorn. That doesn't happen that often, and it'll never happen on an index. And so maybe that's where my thinking about wanting indexes and they're safer, maybe that's where I'm wrong. And I've thought about this for hours and hours before. But so in what I've come to the conclusion, and so I have the max factor, it's like anything else, you need some of each. The index ones are fine. Triple QI may be one of the greatest index funds ever invented. QDTE is a good one. QDTY is a good one. There's lots of good index funds, but they're never going to do this. The index is never, it hasn't in my lifetime, has the index ever doubled at the same time the IV's doubled. So it's just a feature and a benefit. Anyway, so let's look at other ones. Oh, but I was going to say, but here's the reality check. So ever since that day, though, volatility has gone down and has gone down low. And in fact, the last time MicroStrategies rallied, which was April, off the April lows, MicroStrategies went from 237 to 455. Woohoo! We're going to throw a party. Nope. Because unfortunately, this is now trading like an index. When for whatever reason, whenever the market was low, just like an index would do, their volatility spiked, and you actually got one big dividend payment, back there in April, or you got a couple in April, and everyone thought, okay, happy days are here again. Well, no, now it's doing like an index because volatility is decreasing as the price goes up. So what does that mean? It doesn't mean Mister's not a good investment. It just means that that it's two sides of the coin. Your NAV's doing really well, but don't expect a higher dividend until you get the IV to go up. And the problem with that is if you do get a spike from the IV and it happens like it did in April or in March, it's going to be a result of either the market going down or MicroStrategies going down or both. Anyway, so that's my speech on implied vol. I could talk about that stuff all day long. That's a great question, Jonathan. Anyway, all right. Yeah, we can take it offline. Yeah, it was totally for you, but you should watch it. It was a great explanation. And I think the other guys got something out of it too. I'll send you the link. I got a bunch of stuff going. I mean, I'm happy to talk to you offline, but I got a busy day today. I'm stacked day and tomorrow I'm starting, which is good. My station's coming back. We're doing well. Things are going great. All kinds of opportunities coming up. I'm disappointed. The only thing I'm really disappointed about this morning is the max factor doesn't have NVDY on there. I've got to solve that problem. But I have a solution for that. I'll be working on that, but it's just one more thing I need to worry about. But anyway, yeah, watch that explanation. I thought that was a good explanation. Dan, did you like that explanation? Oh, okay. Well, hopefully he saw that. But now let's look. But let's look at something real quick. Like I said, I could talk about this kind of stuff all day long. And the VIX trades, hedging trades, and IV type stuff, and strategy type stuff. This is my wheelhouse. So let's go to Market Chameleon again. And I think the same thing happened in Tesla, and the same thing happened in Coinbase, I think. But let's just look. Let's just look at all Coinbase. Sure enough, same thing. And during the same time period, look at this. So Coinbase's stock price, this is last August, was trading 197, 195, 188, got down to 160, then it went back up to 165. Anyway, it was grinding just under 200 for 6 months, or well, not 6 months, August, September, and October. Okay, well, at the same time, for whatever reason, price wasn't really going up. I mean, it did go from 150 to 200 or something. But during the same time period, Coinbase's IV went from 60 to 94. So that means that's 50%. That means your dividends went up. So that people were falling in love with Coinbase when this happened. Everyone thought, oh, Coinbase, no decay, no erosion. Back in, it was, it was just that it was hot, and it was just that it's doing what it's not supposed to do. But these things can do sometimes. But anyway, then later on in November after the election, then Coinbase breaks out of its range between 160 and 200. Breaks out of that range and shoots up to 324, doubles in a few days. And at the same time, volatility went from 70 to 98. That shouldn't happen, but that's like a unicorn. It happened, and that made people fall in love with Coinbase. Since then, however, it started to act like a normal stock. Look at this. Coinbase has started declining. And then when it declined and the market had a shock in March and April, Coinbase's volatility went up, which is good. You got a bigger dividend if you had Coney, but your NAV was sucking. You were like, oh, man, I want the same dividend, but I want to be a 324. Well, it don't work like that. I mean, because that would be, if it worked like this all the time, if this happened all the time, this would be like free money. And every pension fund in the world would just buy Misty. It doesn't work like that. That was or Coney. That was an anomaly. It's like a bonus to get them to go the same direction at the same time. It'll never happen in an index. So, I mean, this is a good case for holding these single stock funds because it's a possibility. Anyway, so let's see what happened then. So then we got another spike, and that was April, but that corresponded with the low on the stock. That's as low as the stock had been. Went from 360 down to 151. So great. My dividend's more, but, my NAV sucks. Anyway, but then let's see what's happened since then. And then, since then, sure enough, acting like an index or a stock, it's back to the normal relationship because, the price went up. The price went from 150 to 400, but your IV went from 97 to 64. Now, granted, you did have a little bit of the magic here because the price did go from 240 to 400 at the same time the IV went from 50 to 64. I mean, it did have, it's starting to get some of the magic back together there. That's free money right there because they're going the same direction. It's not the usual arrangement. But anyway, man, that's good though. Coney's done it actually more than Misty because Misty just had one time going the same direction. Coney's had two bouts of the magic. Let's see, Tesla did this as well. And probably other ones did this. You guys can look at this yourself. Go to Market Chameleon. But let's see if I'm right about Tesla. No, it doesn't look like I'm really right about Tesla. I think if you go back 2 years, it did this when I was first looking at this. It did this in 2023 when it did that big rally, and it went up at the same time. And remember back then, people were in love, all in on Tesla. Remember, that's all you heard, all in on Tesla, because it was like free money because its dividend was going up at the same time the price was going up. That was mid 2023. It made a high in like June or August of 2023, and its NAV and its IV doubled at the same time. So you had a little free money Tesla trade. Here, let's just see. And this year, Tesla's IV has really been pretty consistent between 50 and 75. The one or two peaks it had corresponded with market drops and Tesla drops. And then since then, Tesla's price has stabilized and gone higher basically. And just like it should, the normal relationship, the IV went down. But yeah, you can, this does happen on some stocks. Let's check out NVIDIA. We'll check out one more. It's always going to happen on the ones that people think are free money. Anything that Rod is calling a goat, he's called Misty the goat. He's called Coney the goat. He's called NVDY the goat. Other influencers we're all in on Tesla. It's just because of this phenomenon happening, and they don't realize it's not the normal thing. But it's good it's good to be in this while it happens. And you can't predict the future. Maybe it'll happen again. So on NVIDIA, well, it's just off the recent. This is acting like a stock. Off the recent, the IV was hit a high into March and April, and then has since declined as the markets rallied. And that's the typical relationship. NVIDIA looks pretty typical. What about Palantir? I mean, Palantir's gone from left to right, lower left, upper right. You know, the IV's been pretty consistent between 50 and 75. The high IV did correspond with lows in the market, and the low IV corresponds with the high, a local high, and this low right here corresponds with another local high. That's back last November, right after the election. Well, we got a little bit of magic in NVDY, and it was after the election. Look at this. Price went from, it was also due to earnings. After the election and earnings, price on NVIDIA went from 41 to right there, call it 80, you know, it doubled. And your IV over the same time period went from 42 to 80. That's back then probably when NVDY was being called the GOAT. Anything that's the GOAT that can do that. That's like the free money trade. It usually doesn't work like that. All right, I'll stop filibustering. What else is up? And I hope you guys understood that, or I hope you guys like that. Yeah, it is a good argument for single ticker stocks, but there's lots of good argument for, I like the argument of, hey, if the market gets crushed, I'm going to get a bigger dividend. And if I'm not spending the dividend on margin, or if I'm not buying my girlfriend a boob job, so I still have the money available. Now, buying a boob job is great, but I mean, my point is the money's gone once you spend it. You know, once you buy a car, it loses 20% of its value the second you drive it off the lot. So that money's gone, even though it may have a value to you, just like your girlfriend having big breasts may have a value to you. But it's, you know, but that the argument for index funds is, hey, if I'm on DRIP, or let's say I'm using the index fund to pay down a credit card or whatever, you know, using it for something effective or something that's building long-term wealth. Let's say I'm paying off my mortgage early with that. That's a good example. I'm taking the interest, I'm paying off my mortgage early. I'm paying double payments on my mortgage, and I'm going to be done in 5 years instead of 10. That's a great use case. So in that use case, you can say to yourself, okay, well, it sucks that my NAV is going down, but my yield goes up. And I think that's the beauty in the yield. If you're doing it on something effective and building equity somewhere, buying stock with it, paying down your mortgage, something like that, that's the case for the index funds. But there's also a case for the single stock funds. So I think it's a good mix is what's needed. You know, I mean, some single stock funds and some index funds. I mean, because yes, it is a good case, but you can't really predict when that's going to happen. But it happens whenever, maybe it's a short squeeze is what's causing that. Maybe the high yield tech funds can short squeeze higher, but at the same time, the volatility goes higher. It just never happens in an index. Yeah, and it's like free money. All right. So what else? You're liking TSYY. Yeah, that was the time. Anyway, hopefully you guys like that, or hopefully, Jonathan, that answers your question. If not, of course, we can take it offline. 100%. So you're liking TSYY. Okay, good. Most I'll do is YMAX or WPay. I just don't have the stuff. Yeah, I thought I did, but it was just a bad case of timing. I mean, it was just when I first got into these, I got Coney and Misty and NVDY, and I love those. And AMD, AMD made me mad. And Blocks, XYZY. I love those. I mean, those are great. But yeah, then whenever the market went down, I just realized I was exposing myself to more risk than I wanted to take on. So then I added the inverse fund. You guys know what I did. I added the inverse fund and put a bunch of it in there, and I stopped the portfolio from bleeding. And then at the bottom, I did get into high risk stocks again, but I used GPTY, LFGY, and ULTY. I mean, there's plenty of risk in those funds, but yeah, no individual tickers. Anyway, price is cheap now and still paying great. So I picked up some more today. Yeah, I'm not knocking. I like Alti. I mean, as much as anyone out there, I promise. And I've liked it for as long as anyone out there, longer. But I just see comments that scare me. I watch other creators' videos, and I'm not going to name any names. A lot of people have great content on Alti, but I was watching a video this morning, and it was actually the creator was doing a good job. He was talking about how to hedge Alti, and he was saying that Salty went totally hedge Alti, and he's right, and he's a very good creator. I enjoyed his show, but I was looking in the comments, and I should have clipped it for you guys. And somebody said, yeah, but next time the market goes into, it's probably somebody that watches this show. I didn't recognize the name, but he said, next time the market goes into an extended downturn, Alti's NAV's going to go to 4 or 5. I mean, guaranteed. And then another commenter said, okay, well, tell me you don't understand options without telling me. And I wanted to get in there and say, no, dude, you're the one that doesn't understand it. Or he may understand options, but he doesn't understand the way ETFs are priced. And that's what I tried to show with the other example with the lightning spread. ETFs are marked to market continuously, so people can get in and out. These aren't closed-end funds, or let's say you're doing the lightning spread yourself. You don't care if you lose money because you aren't marking it to the market. You know that you're 33 out of the money leap. You think the market's going to go up and that leap's going to make you money someday. And so you don't really realize the loss. I mean, you know what happened, but you don't. But in an ETF thing, the loss happens. It's marked to the market because there's people that panicans are going to want to get out and they're going to want their money back. So they have to mark the NAV losses to the market, and so people can get in and out. But then people like you guys, smarter investors or whatever, use those kind of pullbacks to drip and to buy more. And there's all kinds of defenses for it. No right or wrong answers, just like anything. All right, Marcus. I mean, everything's a trade-off. Everything's partially right and partially wrong. There's no absolutes, is what I'm saying. Marcus forgot to include ULTY, YMAX, WPay, or ULTY. Yeah, closest you go to singles. I think ULTY has tons of good single stocks. And I mean, and what about blocks? I mean, blocks is a good one too. So, but I guess the lesson is if you can predict a short squeeze in advance, you can see a mania happening like it was in those cases I showed you. We looked at 5 or 6 cases. And maybe you buy more if you think that's going to happen of that single stock. But just be aware at some point that relationship's going to break and go back to normal. There's a lot of people disappointed that Misty's dividend is so low, but it's not so low. It's exactly where it's supposed to be. I mean, it's behaving it's behaving normally again. For a while, it was, in other words, it's fine. The dividend's fine now, but for a while you were getting a bonus because of something that a lot of people don't understand. Anyway, yeah, Blocks is special. Blocks is special. All right, guys. So I've been on for a long time this morning, but I appreciate you guys. I don't think we have anything else to talk about. I'll be on here at 2:30. Unless I take a nap or something. I'm tired, but I'll try to be on at 2:30, and then let's watch. We can all watch Rod's show together. Maybe I'll even live stream Rod's show, and I don't know. That's kind of I'll probably just watch it. I don't need content that bad. We're just gonna watch it. I'm just gonna do mine, and we'll excuse ourselves at 3:25 and give us 5 minutes for me to go get a soda. And then we'll all watch Rod's show together. But I'm really excited about this Mike Coe. This guy is so smart when it comes to options. And I thought about trying to get him on my show because I always kind of comment in his live stream. He knows who I am because my name, Max Convexity. I mean, he knows what that means. And also I always mention on there, hello from Austin, and so he knows Max from Austin. I don't think he knows the channel or whatever, but I've often thought before he worked for Yomax, hey, I should try to get him on the show and talk to him about he could explain how to hedge the VIX. That guy knows everything. He could explain the different ways to do it. And, and when a ratio diagonal is a better trade than a whatever, I'd like to show him my risk reversal trade and see what he thinks about it. I like an honest opinion from a professional on it. They probably wouldn't like it very much. I mean, that's fine. It's a small newbie trade anyway. But I would love to have him on the show. Anyway, I was talking with Rod this morning. I was telling Rod, congratulations on getting that interview. I'm going to be there. I'm going to watch it. I like Mike. He's a good guy. And Rod said, just ask, you could probably get an interview with them. Now that he works for YieldMax, all I got to do is call up one of my connections at YieldMax. Rod suggested I talk with Josh, and Josh can make that happen. So anyway, we'll see. We'll see if you guys like it. We'll see if you guys like Mike. The reason I know him, he's been on CNBC since ever since I can remember. I don't remember between like 2007 and 2017 that much, but about late 2017, early 2018 is when my memory started again, and he was on CNBC, and I was also getting back into options at that time. So he was on that weekly option show. And anyway, and that's also, he lived in Austin because he was always doing a live remote, and I could tell I was in Austin because he had an Austin background. So anyway, and so I used to look for him at the grocery store because I heard he lives in Terrytown, which is the same place I used to live. Somebody said he lives in Terrytown. So every time I was at the Terrytown HEB, I was looking for him. I always look for him, and I always look for Eric Johnson. Those are the two guys I want to meet in Austin. Anyway, all right, guys. I'll stop filibustering. You guys have what? Oh, okay. Well, hey, thank you. Thank you so much. I appreciate that, Dan. Dan's reaching out to those guys. They have my email. The ball's in their court. Maybe they don't like my coverage. I mean, I don't know. Or maybe they're just too busy. Some people just aren't as aggressive about promoting their funds as other people. Some people have different things. YieldMax is ultra aggressive about promoting their funds on social media. I couldn't believe I got Jay Pestrochelli to talk to me when I had 2,000 subscribers. And all I had to do was send him an email and tell him about, I forget what, efficient market hypothesis. I knew he would just eat that up. I was like, I'm trying to explain the efficient market hypothesis to my guys. And, I know that this is random. And anyway, he just eats that kind of stuff up. And I knew he would. And he goes, oh, yeah. And I go, so I'd love you to come on the show and to talk about the efficient market hypothesis. We get him on. And we did talk about that a little bit. But, yeah, he's great. But then we talked about, my first interview with him was probably the best interview. And I got a great reaction from that interview. But, yeah. So anyway, that was amazing. I could not believe that he was going to come on my show, because he was coming on Adriano's show at the time, who had 30,000. He was on Coach's show, and Coach has always had about double of me. When I had 2, he had 4. Now I have 4. He has 8 or something like that. So I thought I was too small, but no. So anyways, great. Jay's great, but now that Mike Coe works for Jay and Mike Venuto, maybe I can get both my wishes coming true. I can finally meet Mike Coe. I never met him at the HEB Terrytown, or the Terrytown HEB, but I can meet him. I can meet him virtually. So anyway, all right, guys. Well, I appreciate y'all, and I will be back later. If there's anything I forgot to talk about, which I can't not imagine, put it in Discord. All right, guys. See you later. Jackson, come here.